Hey, it's Mitch Goldberg. It's time for Be the Boss of Your Money, my live stream all about personal finance, investing, helping you to become your best version of your financial self. It's the place where we put the personal back into personal finance. You like the way that sounds? I've been working on that for a while. So, yeah, I like that. Putting the personal into personal finance. Make personal finance personal again. Yeah, I like the way that sounds. Anyway, I'm Mitch. You're you. Thanks for joining me. If you have any questions about the topics we're talking about, personal finance, saving for retirement, for college, investing, borrowing, mortgages, buying or leasing a car, hit me up in the comments with your questions so I could see them. And while you're watching, if you don't mind giving me a thumbs up, a heart, an applause, a wow, whatever the reactions are that are available to you on whatever social media platform that you're watching from. I love hearing from you. It's the best part of doing this. Plus, your questions are actually the best kind of content there is. And that's about it. The show is sponsored by me. So, when you click on a like, you help spread the good word. Wendy, I see you out there. Congratulations. Big time on the new home. The view is incredible. And I'm glad, so glad, Robert, my friend, was able to help you out. I did let him know that I know you since like first grade. So it's really important. And I get the feeling he treated it like that. So I was really happy about that. All right. So what are we going to talk about today? A couple of things. There's a lot of talk right now about how the stock market has come too far, too fast. And, you know, there's always chatter about something negative. When the market was down at its so far at its year lows this past June, the talk was, we're not out of the woods yet. The market could go lower. And I've already made a whole video about that I hate the term, but we're not out of the woods yet because we're never out of the woods. There's always something to worry about. Always. Like that nuclear reactor in Ukraine, which Russia has said, it would be a shame if nuclear radiation were to leak because it could spread over Germany and Poland. Yeah, like that wasn't a direct threat. It's basically nuclear war. It's pretty crazy stuff. And yet the market still found a way to go up. The stock market is basically, other than supply chain issues and energy issues and food issues, the actual war itself, I mean, those are big things, I get it, but investors aren't really that concerned about the war. They're really just concerned about the moving pieces of the economic puzzle, right? Um, so that's why the market's able to go up on pretty tough news, bad news. Anyway, what we need to focus on today is, why did the market go up? And that's the thing. People calling for a pullback. Market's gone up too far, too fast. The major averages, are off. Like the S&P 500 is off about, I'm going to say about 9.5% year to date, which is not a disaster. By the way, you can't invest directly into an index like the S&P 500, but you could invest in a security that tracks or mimics an index. Just have to get that in there. So we're going to roll the intro. I'm going to answer that question for you and go over a couple of other things. So here comes. Oh, you know what I want to also do? I want to show you a picture of a sea otter just to get you guys in a good mood. You ready? All right. Isn't he cute? I mean, how cute is that? Okay. You in a good mood now? I mean, if a picture of a sea otter doesn't get you in a good mood, then I don't know. I don't know what does. Here's the intro. We have a lot to talk about. Here we go. Yeah, it seems like this past June, investors had such a fatalistic view of the stock market. Like everything is like, game over. Stock market's game over. This is it. And investors love to have that. Like investors are looking for this, constantly looking for a point of capitulation. Stock market plunges, it's the absolute bottom, and they're going to get in. just like they're looking for the game over fatalistic view. Game over. Bet you've never seen that on a live stream before. All right. Um, so, what else? Yeah. So, market found a way to come back. So here's the thing. Something we talk about. When we're in a bear market, no matter how good the news is from a company or the economy, the stock market finds a way to go down. And in a bull market, no matter how bad the news is from an individual corporate level, the micro level or the macroeconomic level, stocks find a way to go higher. Stocks are moving higher. And I've been saying for a while, this rally is really powerful. It's powerful in part because investors, especially institutional investors who are very sensitive to performance figures like mutual funds, institutional investors, they already have their eye on a specific date, December 31st. Okay. And it's 4 months away, 4.5 months away. And a lot of fund managers have a lot of catching up to do in a pretty short amount of time. So, how do you catch up? You buy the stocks that are going up, the stocks that are already up. It creates a perpetual buying cycle that self perpetuates, self fulfilling prophecy, and the stocks go up and up and up. And I can already see which stocks, in my opinion, are in that zone. Some stocks that were down a lot that have finally got off the mat, and I have those stocks, and if I share them now after saying what I just said, it's kind of like making a buy recommendation publicly on the channel, which is really not something that I should be doing, or nor am I permitted to do. But there are a number of large, heavily owned stocks that represent a lot of percentage of the major average, the S&P 500, and they're moving higher. What's happening is that fund managers, people who are very have a lot of performance anxiety, they are plowing money into these stocks. They've fallen behind their benchmark, and they need to own, these stocks, and that moves the market higher. In addition, we've always said that by the time we get 2 quarters of negative GDP, I've said it right here. You heard me say it, right? The stock market will have already started to go back up. And it's exactly what's happening. Am I clairvoyant? No, I'm just, I've seen this so many times, and it's just, it never changes. That's what that is. So I'm telling you this because I want to encourage you to stick with your plan. Now, I know it's tempting to make moves. I'll sell industrials to buy energy, and then energy goes down. So now you'll sell energy to buy, I don't know, something else that's going to go down. And I just think you're making a mistake when you start to do this buying and selling, and you're trying to play Frogger with your money. You remember the game Frogger? You try to land on the turtles to get across the river, right? It's an old video game. Check it out. So that's what I'm trying. That's what I'm trying to convey to you. So I don't want you making these kinds of mistakes. Jerry, I see you out there as well. Thank you for joining me, buddy. Are you still in Florida? I want to know. I'd love to see you. Some really cool things to catch up on. Some cool things to catch up on. All right. So that's what's happening, and that's why when the market started down today, I didn't bat an eyelash. I was thinking, this is going to turn around because we are in a position of strength in the market. Market's going higher. Earnings season has come out. Not so bad. Inflation last month has moderated a little bit. Still up a lot, but moderated a little bit. And yet employment is still very healthy. Jobless claims were a little bit lower than expected today. 2 weeks ago, we had that big employment number, over 500,000 jobs created. Okay. So moderating inflation, still decent labor. It's one thing to have inflation when you have a lot of unemployment, but at least now you have employment to go with the inflation. So at least people are working. This is really not too bad of a situation at all for stocks. And the benefits of the Federal Reserve moves of raising rates, we talked about the yesterday and last week and the week before, and the week before. It's not so much as the Federal Reserve raising or lowering interest rates. It's more of a matter of that the Fed projects backbone, that the Federal Reserve is showing strength to give investors confidence that it's doing the right thing. That confidence in the Fed is returning after an embarrassing moment of letting inflation get out of hand. It's not just the Fed, but a big part of it. And that's helping the market. Okay. So that's what's going on in a nutshell. And there we go. Did we run the introduction yet? I think we did. I'll run it again just in case. Actually, we did run it, but I just want to make sure. Listen, the worst thing that happens to me is when I get a call from compliance. Hey, Mitch, you have to take that video down because I didn't do something, right? It makes you a little paranoid. All right, Jerry in New York. Thank you. Howie, question. What about hedging your portfolio with options? I don't think it's a good idea. So why am I so emphatic about it? Might sound good on paper. There's a few key reasons why I don't like to hedge a portfolio with options. Okay. My preferred way to hedge a portfolio is to sell stocks, lower my stock exposure. So index funds or individual stocks, what have you, raise cash. That's a good way to hedge a portfolio. And it doesn't cost you anything. I mean, you're not paying a fee to hold the cash. Well, the cash itself, I'm not talking about fee-based accounts, but options, you pay something. You have to pay for the options. And using options as a hedge is very expensive. And one of the components of options is time value. If you buy an option that expires in a week, there's very little time value to it. But if you buy an option that expires in a year, there's a lot of time value to it. Options are a form of derivatives that involves unique risks. And I don't know if everybody understands them. But if you buy an option and you pay, let's say $5,000 for an option to hedge something a year from now, and whatever you thought, whatever you were hedging against doesn't happen, the option would expire worthless. All right. And maybe that's a risk you're willing to take. But it does cost a lot of money to do it. So why are you hedging? Right? What does that have to do with your personal finance? Now, options are a component of two things: time value and how much higher or lower they are than the particular strike price compared to the current price of the underlying stock. And that's basically what gives an option value or lack of value. So if you want to hedge your portfolio, if you're a long-term investor and you're investing in the stock market for the long term, then you know that the stock market goes up and down. Oh, because your $1 million portfolio might go down to 700,000. So hedge against that. But if you're in it for the next 15, 20 years, 10 years, you know that your portfolio is going to do that once in a while. But that has nothing to do with personal finance. Now, if you know, for example, that you need a portion of that $1 million to buy a property, and you need money for a down payment from your stock market money, and that purchase of property is a year, 2, 3 years away, well, then you would, and let's say you were going to need, $200,000 as a down payment, you would take that $1 million portfolio and sell $200,000 worth of securities now to protect slash hedge that portion of the money. That's letting personal finance be your guide. So I would rather hedge by raising cash based on my personal finance needs. Child's coming up to college. This is why so many people use age based portfolios for 529 plans, because as your child gets older, 14, 15, 16, 17 years old, their account becomes more and more conservative, meaning less volatile investments and more stable investments like cash, right? That to me is a much better way to hedge. Let your personal finance guide you. But to run out and buy derivative contracts to protect a portfolio, then presumably you need that money over the near term. If you're worried about your portfolio going down over the near term from a market calamity or just a generally down market or a bear market, then you presumably you need cash, so that money would already come out of the market. And I think that's a much better way to go than to spend a boatload of money buying protection. Okay, it's not quite. Some people say, "Oh, you insure your car, you insure your house." It doesn't really translate. You can't protect your house by turning it into cash. You or your car or your health. So it doesn't really make sense calling the term portfolio insurance. There was a time when a lot of investors believed in portfolio insurance, and on October 19th of 1987, the stock market plunged in big part because people wanted portfolio insurance. Hope that answers the question. I think it's a great question, and I'm really glad you asked, Howie, because um, I think a lot of people have questions about that. All right. So, in any event, the market continues to show its bullish side for a number of reasons. And generally speaking, I can't say for sure if we're in a new bull market, but we are in a powerful rally. And with large investors who have performance anxiety focusing on December 31st, they need to buy every dip. And that's why yesterday, when the market dipped, market bounced off its lows, and today moved up because dips are meant to be bought. We're back to buying the dip, but it looks like it's really all about quality, not just buying the dip on pandemic stocks or meme stocks. To me, that's what I see. Let's take it to the big board and just take a look at a couple of things. All right, Dow up 18, no big deal, but after it was down a lot earlier today, down a good amount, I'll take an up day. Nasdaq up 27, no big deal. S&P up 9 points, no big deal. Gold was off yesterday. It's off a little bit today. You know, for all those people that put all their money into gold 5, 10 years ago, I just don't like all or nothing positions. If you have a portion of your investments in gold, good for you. You call it diversification. By the way, diversification is a strategy that we use to mitigate risk, but it doesn't eliminate risk, and it certainly doesn't protect your portfolio from going down in a generally down market. See, I worked that disclaimer in there. I just make it like it's part of the conversation. Oil up to 90, that's okay. It's not, I always want to see it go down, not up, but we don't want to see oil go down too much because then we're in a really nasty recession. If it goes up too much, then we see inflation, and once oil goes up too much, it creates an oil shock. Then we go into a recession. It's like oil is, it's hard to win, right? 10-year yield 2.88%, so below 2.9. The VIX still under 20. The VIX, it's barely holding that level, but we like to see that under 20 continues the rally. Let's look at the yields. Uh, Yields were mostly down today. They've been rising the last couple of days, very slightly, slightly backed off. The 10-year yield still under 3%. It's 2.886, and it's still a good deal lower than the 3.2%. How much lower? It is 0.32. See, that's the yield curve right there, the difference between the 2-year treasury and the 10-year treasury. You want that to be a positive number. Right now, it's a negative number. Okay. See that negative? That means the yield curve is inverted, negative number. Not a great sign for the economy. We'll see if it can reverse. All right. 30-year mortgage at just about 5.5%. Um, Floating rate ETF, nothing special. Um, I'm just following some of the 10-year treasury, the VIX. Already looked at those. Tip, that's the iShares Tips bond ETF, up a drop. The Vanguard bond market, up a drop. Bond market index fund. But from 86 to 75, bonds have done really badly this year. I don't think people realize it. And that's why people are scratching their head saying, I thought I would be doing better. I thought I was more diversified. My portfolio would hold up better in this market. The problem is the portion of your portfolio that would ordinarily hold up, even go up in value in a down market, has also gone down in value, and that's the bond market. It's just a very unusual year, one of the worst years ever for the bond market. It's not going to be like this every year. It's just a now thing. Okay, that's what I think. Let's take a look at the FANG stocks. Apple, not far from its all-time high. Amazon climbing back up. Alphabet bouncing off its low. Facebook, I think of all of the big heavies, Facebook and Netflix are the two that people have the least amount of confidence in. I have more confidence in Meta than I do Netflix. I think Meta, which is Facebook, I think they still have a lot of levers to pull for advertising, and they'll eventually figure out how to keep targeting ads to you. There's some privacy issues that Apple is doing when you use an iPhone. And it's been hurting companies like Facebook slash Face Meta. I think Meta will eventually figure a way around it. Um, Netflix from 700 to 245. I don't think people realize how down Netflix is. Nvidia too is getting cracked, and that's like a premier semiconductor stock, at least perceived to be one. And let's see, the sectors that did best today was energy, which has been going down lately, so it's bounced up a little bit. Tech up a drop, industrials up a little. What didn't do well? Nothing, no disasters. Real estate off a drop, healthcare off a drop, communication sector, which is basically Netflix and Facebook down. Um, Discretionary off a little bit. I know you're thinking Netflix and Facebook as technology. They are tech, but they fall under the communication space, according to S&P, Standard and Poor's. So that's where we are. Um, I hope you enjoyed today's show. Keep hanging there. A couple things that are on my mind. One of them is I had lunch with a friend, dear friend of mine, a client, and she asked, "Is there anything we should do? Like, should we do anything? Should we buy? Should we sell?" We've got mostly mutual funds, just because it's. I hardly ever use mutual funds, but this, the client, this is purchased probably 20 years ago, so we're just going to leave it. But I don't want to buy and sell. We've got some individual stocks, some ETFs. And my point to her was, when you start buying and selling, you're trying to leapfrog onto the next thing, play that Frogger game. You might be right 10, 20 times in a row. But all you have to do is be wrong once to ruin it all. Just hang on to what you have, hang on to quality, and don't play with it. I think the less you do with regard to your investments in terms of activity, trading activity, the better off you're going to be, not the worse off. We have this temptation for fight or flight, when really the best thing to do is nothing. It's hard to do nothing when you're worried, because doing nothing just means you keep worrying. I get it. But when it comes to investing, that is the kind of personality trait that it takes to really be successful. And if you don't have that personality trait, or you have trouble with that, that's what I'm here for. Your coach, right? Your financial coach. All right. So that's about it. I thank you so much for watching. I'm going to end the broadcast now. I'll see you guys on Monday, unless something totally crazy happens in the market tomorrow. And if you think of any topics that you want me to cover, let me know in the comments. Shoot me an email. Call me. I love hearing from you. I'll talk to you soon. Thank you very much.